$38 trillion. That's America's national debt right now, not a projection, not a future estimate, but the actual debt sitting on the books as of December 2025. And if you think this number doesn't directly affect your financial future, you need to understand what's happening behind the scenes in global finance. While most people scroll through social media and stream their favorite shows, the world's largest financial institutions have started doing something unprecedented in the modern era by systematically moving massive amounts of capital out of dollar-denominated assets. And this isn't conspiracy theory or speculation, because this is documented in public filings, treasury data, and capital flow reports that anyone can verify. What I'm about to share with you is a pattern that has repeated 3 times over the last 500 years, and each time it followed identical stages, showed the same warning signs, and led to the same devastating outcome. And right now we're watching this pattern unfold again in real time. So the only question is whether you'll recognize it coming, or whether you'll join millions throughout history asking how you missed all the signs that were right in front of you. Global debt recently hit $251 trillion according to the International Monetary Fund, which represents 235% of global GDP, making it the highest ratio in recorded peacetime history. And to put America's situation in perspective, U.S. debt jumped from $36.1 trillion in January 2025 to $38.4 trillion by December, which means a $2.3 trillion increase in just 11 months. But here's what most analysts aren't telling you. This exact scenario has happened before, 3 times in modern history, and each time the country holding the reserve currency collapsed within 36 months of the smart money beginning to leave. And these weren't similar collapses because they followed identical patterns with the same stages, the same timeline, and the same result, making the pattern mathematical, predictable, and unfortunately unstoppable once it reaches a certain critical point. Every major economic collapse in the last 5 centuries has followed a precise 4-stage cycle, and understanding these stages is crucial to recognizing where we are today. Stage 1 is the ascension phase, where a nation becomes the center of global finance and capital floods in from everywhere. Their currency becomes the standard for international trade, and everyone wants exposure. Banks expand rapidly, markets boom, and innovation accelerates while the future appears limitless and confidence becomes absolute. And this stage typically lasts between 50 and 80 years. Stage 2 is the overextension phase where success inevitably breeds arrogance, and the government begins spending beyond its means, funding military expansion, foreign interventions, and domestic programs, all with borrowed money. So debt grows faster than the economy, but nobody worries because asset prices keep rising, real estate booms, stock markets hit record after record, and everyone feels wealthy on paper while central banks print money to keep the party going. And this stage typically lasts 20 to 40 years. Stage 3 is the silent exodus, which is the critical phase we need to watch most carefully because the smart money, meaning institutional investors who actually read balance sheets, begins to see what's coming. Not the general public and not the politicians, just the people managing massive pools of capital, and major institutions start quietly rotating their holdings out of the dominant currency with no announcements. No press releases, just systematic calculated movement into safer jurisdictions as foreign investors reduce holdings. Wealthy families diversify internationally, and the exodus begins slowly at first, then accelerates, lasting typically 18 to 36 months. Stage 4 is the collapse, where the currency loses reserve status, foreign central banks dump their holdings, inflation explodes, interest rates spike, asset prices crash simultaneously, banks fail, pensions evaporate, the middle class gets destroyed, political chaos follows, and everyone asks the same question about how they didn't see this coming. And the answer is always that the pattern was there all along. Now let me prove this pattern is real with 3 historical examples spanning 3 global superpowers, 3 reserve currencies, but the same exact cycle and the same exact outcome. In the 1500s, Spain was the most powerful empire on earth with no debate and no competition as Spanish galleons returning from the Americas were loaded with more gold and silver than had ever been seen in human history. The Spanish real was the global reserve currency, and if you wanted to trade internationally, you needed reals, while Madrid was the financial center of the known world, completing stage 1. King Philip II controlled half of Europe, Spanish armies were considered unstoppable. The Armada ruled the seas, and wealth poured in from every colony across 3 continents. But what did they do with it? They spent it on everything, including wars with France, England, the Ottoman Empire, and the Dutch, maintaining a massive military presence spanning 3 continents, supporting a bureaucracy that consumed fortunes, building royal palaces that cost kingdoms, and funding the Spanish Inquisition, burning money along with heretics. So by 1550, Spanish government spending was running at 300% of revenue, 3 times what they collected in taxes, with the difference borrowed from Italian banks, German merchants, and anyone who would lend. But gold kept flowing from the New World, so nobody worried, while asset prices in Spain kept rising. Everyone felt rich, and the empire seemed invincible, verifying stage 2. Then something changed quietly in 1555 when major Spanish banking families started moving assets to Genoa. The Fugger family, who were Spain's biggest creditors, began demanding repayment in gold instead of promises because they wanted out. And by 1556, wealthy merchants transferred operations to Amsterdam, not all at once, but gradually, by opening offices, moving inventory, and redirecting trade routes. And why? Because they could read financial statements, and the statements said Spain was functionally bankrupt, as the Spanish government was paying 40% interest on some loans, and 40% isn't a sign of strength, but rather desperation bleeding through official documents. Documenting stage 3. In 1557, Spain defaulted on its debts for the first time, causing credit markets to freeze. Spanish bonds became worthless overnight. The government seized private gold shipments to pay soldiers, and chaos spread through the financial system. But the king promised it was temporary, a one-time problem, and that everything would be fine. Yet Spain defaulted again in 1560, again in 1575, again in 1596, and again in 1597. Making 4 defaults in 40 years as the currency collapsed, inflation destroyed the middle class, and Spanish power evaporated like morning fog. So by 1600, Spain was a shadow of its former self, as the Golden Age was over forever and it never came back, completing stage 4. And where did the money go? North to the Dutch Republic, where Amsterdam became the new center of global finance. Which brings us to example 2 in the 1600s, when Amsterdam was the richest city in the world by far and by every measure, as the Dutch East India Company was worth $8.28 trillion in today's money, which is more than Apple, Microsoft, Amazon, and Google combined times 2. Dutch banks financed global trade. The Amsterdam Stock Exchange was the first in history. The guilder was the world's reserve currency, and international business required guilders, period, while capital flowed into Amsterdam from everywhere, including Asia, Africa, the Americas, and Europe, as money-seeking returns found its way to Dutch banks, making the Dutch Republic in the 1600s like Silicon Valley, Wall Street, and London combined into 1 square mile, creating an undeniable stage 1. Then came the wars. Always the wars, including 3 Anglo-Dutch wars between 1652 and 1674, wars with France, wars with Spain, and a Dutch military presence stretched from Indonesia to Brazil to South Africa, and it all cost enormous amounts of money, as government debt increased from 4 million guilders in 1650 to 80 million by 1690, a 20-fold increase in 40 years. And to pay for it, they printed, which should sound familiar by now, while meanwhile tulip mania hit, with tulip bulbs selling for more than houses, as a single rare bulb could cost 10 times an artisan's annual income, creating asset prices completely detached from any economic reality, while everyone was getting rich on paper. And the Bank of Amsterdam, supposedly the safest institution in Europe, was secretly lending out depositor money to fund government wars by running fractional reserve banking before it had a name. Essentially a Ponzi scheme dressed in legitimacy, checking off stage 2. In 1690, the smart money started moving as major banking families transferred operations to London. The Sephardic Jewish merchants who'd made Amsterdam wealthy began relocating, Portuguese traders opened offices in England, and German financiers pulled capital out systematically over years. And why? Because the insiders knew something the public didn't, which was that the Bank of Amsterdam was broke and had been since 1672, as they'd been using new deposits to pay old withdrawals for decades in classic Ponzi mechanics. But the secret was kept until it couldn't be kept anymore, verifying stage 3. In 1795, French revolutionary armies invaded, the Dutch Republic fell, the guilder collapsed, the Bank of Amsterdam's fraud was exposed, depositors lost everything, riots filled the streets, political chaos erupted, and the Dutch Golden Age ended just like that, as 150 years of dominance disappeared in months, completing stage 4. And where did the capital go? London, because Britain was next and the cycle continued. Which brings us to example 3, and this one matters most because it's the most recent and closest to our current situation in the 1700s to 1900s when the British Empire operated under the famous line that the sun never sets on the British flag. And at its peak, Britain controlled 23% of the world's population and a quarter of Earth's landmass. The pound sterling was the global reserve currency for over 200 years, which is longer than any currency in modern history. The City of London was the center of global finance. And if you needed capital for anything anywhere, you went to London, as British banks financed railroads in America, mines in Africa, plantations in Asia, and infrastructure on every continent. While over 60% of international trade settled in pounds, the gold standard was built around sterling, and British power seemed infinite and eternal, representing absolute stage 1. Then came the 20th century and 2 world wars, as World War I cost Britain £44 billion, which is over $600 billion in today's money. They borrowed from America, from their own citizens, and from anyone who would lend, causing government debt to go from 30% of GDP to 130%. And you should remember that number of 130% because it's the same level America is at today, and they tried to stay on the gold standard but failed in 1931, tried again after briefly returning, but failed again in 1933 as the system was breaking, while World War II made everything worse with more debt, more printing, and more promises they couldn't keep. So Britain ended the war technically victorious, but financially destroyed, broke, and dependent on American loans to survive, checking stage 2. In 1949, the quiet exodus began as major British corporations started moving operations to America, including Unilever, Shell, and British Petroleum, not shutting down in Britain, but shifting investment, redirecting capital, and building elsewhere, while wealthy British families transferred assets overseas to Switzerland, to America, to Canada, and to anywhere that wasn't overtaxed, overregulated, declining Britain, and the brain drain accelerated as scientists, engineers, entrepreneurs, and academics all left for opportunities in America because Britain offered high taxes and declining prospects, while America offered growth and opportunity, making the choice obvious. So by 1964, an investment in Britain had fallen 62% from pre-war levels as the money was leaving, the talent was leaving, and the future was leaving, checking stage 3. In 1967, the pound devalued 14.3% overnight, meaning one day you wake up and your currency is worth 14% less, and the government had no choice because they'd run out of foreign currency reserves defending the exchange rate as the game was over. Then in 1976, Britain went to the International Monetary Fund for a bailout, an actual bailout. As the former global superpower, the empire on which the sun never set, had to beg for emergency loans like a developing nation in a moment of complete humiliation. The pound lost reserve currency status, international trade shifted to dollars, and Britain's century of financial dominance ended forever, verifying stage 4. 3 empires, 3 reserve currencies spanning 500 years, same 4-stage pattern, same outcome, as Spain, the Dutch Republic, and Britain all followed the exact same path from dominance to collapse. And now let me show you why America is in stage 3 right now. In 1944 at Bretton Woods, America became the global reserve currency, with the dollar backed by gold at $35 per ounce, while other currencies were backed by dollars. As the system was born, America won World War II, while Europe and Asia were in ruins. Capital flooded into America. U.S. markets became the deepest and most liquid on Earth. Everyone wanted American assets, including stocks, bonds, real estate, and treasury securities as the Golden Age began, and this lasted from 1945 to 1971, a full 26 years of absolute dominance, completing stage 1. On August 15, 1971, Richard Nixon ended gold convertibility, making the dollar pure fiat currency with no gold backing, no commodity backing, just faith in the U.S. government and just trust. And what happens when you remove all limits? Spending explodes, as in 1980 U.S. national debt was $900 billion, which seemed like a big number, but watch what happened next. 1990 brought $3 trillion. 2000 brought $5.6 trillion. 2008 brought $10 trillion. 2020 brought $27 trillion. January 2025 brought $36.1 trillion. And December 2025 brought $38.4 trillion, representing a 4,200% increase in 45 years as the debt more than doubled in just 5 years. But that's only government debt, and just part of the picture, because corporate debt hit $13.50 trillion. Household debt reached $18 trillion. Student loans totaled $1.77 trillion. Credit card debt hit $1.1 trillion. Auto loans reached $1.6 trillion. Medical debt ran into hundreds of billions, and total U.S. debt exceeded $100 trillion, which is 370% of GDP. And for context, Spain defaulted at 200% debt to GDP, the Dutch Republic collapsed at 250%, Britain lost reserve status at 130%, yet America is at 370% and climbing. How do we pay the interest? The government now pays over $1 trillion per year just on interest payments, which is more than defense spending, more than Medicare, and more than most entire government agencies combined. That's $1 trillion just for interest, not paying down debt, but just interest. And how do we fund that? We print money, as M2 money supply increased from $15.5 trillion in February 2020 to $21 trillion by April 2022. A 40% increase in 26 months, representing the largest monetary expansion in American history ever and by far. And what does that create? Inflation, asset bubbles, and wealth inequality. All the classic signs of stage 2 as the stock market hits all-time highs while real wages stagnate for workers. Price-to-earnings ratios reach dot-com bubble levels. Housing prices jumped 73% since 2019. And everything's inflated as every asset class is simultaneously overvalued. While the Federal Reserve's balance sheet went from $800 billion in 2008 to $9 trillion in 2022, as they bought everything, including treasuries, mortgage-backed securities, and corporate bonds to prop up asset prices artificially, completing and verifying stage 2 mathematically. Now here's where it gets really interesting with stage 3, the exodus. As China held over $1 trillion in U.S. treasuries in 2013, but today holds $760 billion, meaning they've sold over $300 billion in the last decade in documented public record. Japan, as the largest foreign holder, reduced their position by $220 billion since 2022 by selling quietly month after month. Saudi Arabia is selling, Belgium reduced holdings, Switzerland is selling, France is reducing exposure, and even the Federal Reserve itself is reducing its balance sheet through quantitative tightening by letting bonds mature without reinvesting and draining liquidity from the system. So who's buying U.S. debt now? Mostly the U.S. government itself, the Federal Reserve, and government pension funds and circular financing, essentially printing money to buy your own debt. And that's not strength, but desperation. And it's not just governments, because major financial institutions are restructuring as BlackRock, the world's largest asset manager with over $10 trillion in assets, has restructured portfolios, reduced U.S. Treasury exposure, and increased positions in emerging markets, European infrastructure, Asian real estate, gold, and commodities by diversifying away from concentrated dollar exposure. While J.P. Morgan restructured institutional allocations, Goldman Sachs reduced U.S. equity recommendations. Morgan Stanley increased international allocation guidance, and Bridgewater Associates has been warning about dollar devaluation for years and positioned accordingly, showing that the smart money is moving just like they did in Spain, in Amsterdam, and in London, checking and verifying stage 3. Now let me tell you what happens in stage 4 based on the pattern, based on history, and based on mathematical inevitability, as the dollar gradually loses reserve currency status. Not overnight and not with a single announcement, but gradually, then suddenly. Countries start settling trade in other currencies like yuan, euros, and bilateral agreements that bypass the dollar entirely. And it's already happening as China and Brazil trade in yuan, India and Russia settle in rupees, and BRICS Nations develop alternative payment systems, while over 40% of global GDP now sits in BRICS-aligned countries building infrastructure to trade without dollars. And here's a critical point. There was widespread reporting in June 2024 about the petrodollar agreement ending. So let me be clear about what actually happened as the 1974 U.S.-Saudi Joint Commission on Economic Cooperation expired. But fact-checkers confirmed there was never a formal written agreement requiring Saudi Arabia to price oil exclusively in dollars, as it was an informal arrangement. An understanding, however, and this is crucial, Saudi Arabia has recently indicated willingness to accept other currencies for oil as they've explored yuan-denominated transactions. So the practical effect is the same as the dollar's exclusive grip on oil markets is loosening and the petrodollar system is fracturing, just more slowly than sensational headlines suggested. When dollar demand drops significantly, what happens to all those dollars sitting in foreign central banks? They come home flooding the U.S. economy. And that's when inflation goes vertical as the Fed will face an impossible choice. Raise interest rates dramatically to crush inflation, which makes the $38 trillion debt completely unpayable and crashes the economy. Or keep printing, which destroys the currency through hyperinflation. And either path leads to the same place where asset prices crash because liquidity disappears, stocks, bonds, and real estate all deflate simultaneously, banks fail, pension funds go insolvent, insurance companies collapse, the cascade begins, and the middle class holding most of their wealth in dollars and dollar-denominated assets gets completely wiped out as savings evaporate, retirement accounts vanish, and home equity disappears. And this isn't speculation because this is the pattern and it's happened every single time. Now I know what you're thinking. But America is different because we have the strongest military in history, the most advanced technology, the best universities, and the most innovative companies. So this time won't be the same. But let me tell you something that history proves over and over, which is that Spain had the most powerful military in the 1500s, yet it didn't stop economic collapse. The Dutch had the most advanced financial technology of the 1600s as they invented modern capitalism. Stock markets, central banking, and options trading, yet it didn't stop collapse. Britain had the largest empire in history with the Industrial Revolution, a global navy, and unmatched trade networks where the sun never set on the British flag, yet it didn't stop collapse, showing that military power doesn't prevent economic mathematics. Technology doesn't stop currency debasement. Innovation doesn't overcome fiscal insanity. And exceptionalism is just a story empires tell themselves before they fall. But what about the Fed printing infinite money because they'll never let the system collapse? Well, they printed infinite money in Weimar Germany where hyperinflation destroyed the middle class and savings became worthless as a wheelbarrow of cash couldn't buy bread. They printed in Zimbabwe, creating $100 trillion notes that became completely worthless pieces of paper. They printed in Venezuela where inflation hit 1,000,000%, and people were eating zoo animals to survive while doctors and lawyers worked as taxi drivers. They printed in Argentina, leading to multiple currency resets and decades of poverty despite massive natural resources, proving that printing money doesn't create wealth, but transfers it from savers to debtors, from workers to asset holders, and from the middle class to the financial elite until confidence breaks, and then it accelerates the collapse. Because every empire thinks it's different, every reserve currency believes it's permanent, and they're always wrong as the pattern doesn't care about narratives, doesn't need your permission, doesn't wait for consensus, and just unfolds like clockwork, like mathematics, like gravity. And right now, all the indicators are screaming stage 3. So what does this mean for you practically and specifically starting today? First, if most of your wealth is in dollar-denominated assets, you're exposed. Not might be, but are. And diversification isn't a nice-to-have anymore, but survival. So consider assets that hold value during currency debasement like gold, which has held value for 5,000 years across every civilization, along with silver, commodities, and real assets that can't be printed into existence by central banks. Second, consider geographic diversification because if major institutions are moving capital internationally, you should consider following, not with all your money, but with some. So research stable foreign currencies like Swiss francs, Singapore dollars, and Norwegian kroner to spread political risk across jurisdictions. Third, Understand the timeline because stage 3 doesn't last forever, as historically it runs 18 to 36 months from start to finish, and we're probably 12 to 15 months in based on when foreign selling accelerated, meaning you have time, but not years, just months, so use it wisely. Fourth, increase liquidity by keeping accessible cash because yes, it loses value to inflation, but in a crisis, liquidity gives you options to buy crashed assets and to move quickly when opportunities appear, while illiquid assets trap you exactly when you need mobility most. Fifth, reduce debt because high debt in a rising rate environment is financial suicide. So if you're leveraged, you need to deleverage now, as every point interest rates rise makes your debt more expensive to service, and rates are structurally going higher from here. Sixth, invest in skills and relationships because the one asset that survives every collapse is human capital, including skills that create value, knowledge that solves problems, and relationships built on trust, and these can't be inflated away or confiscated by governments. Seventh, stay informed because the people who survive these transitions are the ones who see them coming, who understand the pattern, and who don't wait for mainstream media to confirm what's already obvious from the data. This isn't fear-mongering but pattern recognition. This is 500 years of economic history showing you the same cycle over and over and over. America's debt hit $38 trillion for a reason, foreign central banks are selling for a reason, and major institutions are diversifying for a reason because they see the same pattern you just learned, the same pattern that destroyed Spain, that destroyed the Dutch Republic, and that destroyed Britain. And we're in stage 3, the capital flight phase, the silent exodus, as the smart money is leaving and the warning signs are everywhere if you know what to look for. Stage 4 is coming. The mathematics are inevitable, and the only question is whether you'll be positioned correctly when it hits, or whether you'll be asking like millions throughout history how you didn't see it coming when all the signs were right there in front of you. Because the information is here, the pattern is clear, the data is verifiable, and the choice is yours. The pattern doesn't care if you believe in it, doesn't need your faith, doesn't require your acceptance, and just unfolds like every time before. And remember that the people who survive these transitions aren't always the ones with the most money, but the ones with the best information and the courage to act on it.